Now, good evening, everyone. Warm welcome to all the participants for this VCM on development of properties. We have with us CA Nitin Bhutta, who has written a very nice and wonderful article, or you can say a booklet on the issue of self-development. We also have with us CA Nitin Yolekar, who is management committee member of the Pune CP Study Circle. And our own Aishwarya Boite is there, who is the Vikasa Vice Chairperson. So we welcome all for this VCM today. It gives me pleasure to give the opening remark as Vice Chairman of the Pimpri-Chinchwad branch. I am CA Sachin Bansal, Vice Chairman of the Pimpri-Chinchwad branch of WRSF ICI. Today's topic is very important nowadays because, as you see in Pune, at least I see that many properties are going for self-development or redevelopment, as we can say, because there are many properties who are very old and some are in also dilapidated conditions. So it is necessary that we all the society members agree and go for self-development. So there are various other issues in terms of GST and income tax when we go for redevelopment. So Nitin Bhutta sir will be explaining us about all the issues involved in that self-development. And before leaving, I also want to add that we are having a national conference on IBC, the Insolvency and Bankruptcy Code, which is being held on 9th and 10th December at Gokhale Institute in Pune. It is jointly held with Pune and Aurangabad branch. So I request all the participants here to please register for this important national conference, which has 12 CP hours for 9th and 10th December. So I now request Aishwarya Boite to introduce today's speaker, CA Nitin Bhutta sir.
A very warm welcome, everyone. Yes,
yeah, Aishwarya, you can introduce the speaker.
A very warm evening, and welcome to all of you. So today here I am, and I'm taking this pleasure of introducing you all to CA Nitin Bhutta sir, our eminent speaker for today's session. CA Nitin Bhutta sir is a graduate from Mulund College of Commerce, Mulund. He became a chartered accountant just 16 days before completion of his articleship training in year 1992. He is a proprietor of Nitin Bhutta and Co-Chartered Accountants based in Mumbai. This year, his firm would complete more than 30 years of practice. He has secured 13th rank in All India level of CA Intermediate. He has successfully completed course on Independent Director Studies conducted by Bombay Chartered Accountants Society and SP Jain Institutes of Management Studies. He is a regular writer of articles which are published in public digital domains like GST PAM Magazine, Tax Guru, and CA Club India. He is a regular speaker at WIRC, NACIN, GST certification courses, as well as at various study circles in Mumbai as well as outside Mumbai on GST. He is one of the panelists on WIRC for resolving the queries on GSTR 9 and GSTR 9C as well. He is also founder member cum honorary treasurer of Confederation of GST Professionals and Industries representing GST on pan-India basis. He has exposure in various industries like advertising, entertainment, research, pharma manufacturing, banking, celebrity management, medical fraternity, skincare, construction, event management, business process outsourcing, film production, etc. in the field of accounting, direct and indirect taxation as well as management advisory services. He presently is actively involved with limited scale of doing audits, direct and indirect taxation, management advisory services, as well as handling litigation matters of corporate as well as non-corporate persons up to the tribunals. Presently, he is actively involved in vetting out of drafted legal documents pertaining to business arrangements from tax compliance perspectives. Apart from the above, he enjoys traveling and reading a lot. He has traveled almost in all parts of India, and he has also visited USA as well as Caribbean islands. It is my immense pleasure to introduce you, sir, and I hope that today's session will be most benefited to all of the students with us here. Now over to you, sir.
Thank you, Aishwarya, for the words of introduction. I appreciate the way you introduced me. I thank Pimpri Chinchwad branch of ICI as well as the Pune CP Study Circle to invite me for this intricate topic of society redevelopment. First of all, I would like to thank Nilesh ji for approaching me for this particular session. The topic what I'm going to touch upon is from the two statutes, basically the income tax statute as well as the GST statute. What I have tried in my presentation is the initial several slides will establish the foundation for the purpose of the discussion for the benefit of all participants, which will explain what is the concept that we are driving to discuss in this particular 3-over VCM. Am I audible enough to everybody? Hello?
Yes. Very
Okay. So with this, I would like to start sharing my presentation. Is this visible? Hello?
Yes, perfect.
So let me tell you friends very clearly that typically all the speakers will give their disclaimer at the end, but I would like to give my disclaimer in the beginning. I'm going to express my views on the topic, which may be correct or may be incorrect. But whatever I'm going to share, that is as per my understanding of the subject. And it won't be binding on the study circle as well as the ICI. I would urge everyone to read the tax provisions on their own. And after the deep study, they can advise their clients suitably based on the understanding. And during my deliberation, if I give any examples which are similar to your clients or my clients, let me be very humble to say it is a purely coincidental to share such information. I don't have an intention to share anything in public domain about anyone's affairs in general. And one more thing which I would like to say, I'm not here to prove myself today on this intricate topic of redevelopment, but I'm here to improve myself by doing the deliberations and learning from the interactions of all the participants. I would have preferred this session to be physical rather than a VCM session, because physical session interactions is much better. But in the VCM, the interaction is very, very limited because it can be always done at the end of the session. And as a speaker, I can't make out what is the reaction of the participants to the deliberations that are happening. But let me tell you very honestly, in this whole discussion, I will try to be as simple as possible. I will not be technical to discuss anything. I would be citing a couple of judgments during the discussions, but only one request to everyone. Before relying on any particular judgment for the purpose of your defense or to your matter under consideration, please read every judgment under lens and verify with your own facts whether it is applicable or not. And if it applies, then only I will recommend to apply that particular judgment. Otherwise, don't use that judgment as a reference at all. The broad outline, I will have defined the common terms which I have used during the presentation. What are the foundation concepts about the topic? What are the income tax concepts revolve around the topic, followed by the similar concepts under the GST? What is the history of society redevelopment? What are the transfer implications for the society redevelopment? Consideration, rates of taxes that are in force under the IT as well as the GST. Input tax credit reversal. GST on joint redevelopments and or redevelopment agreements as the case may be. Right in land or building or removable property. Income tax exemptions arising on account of the society redevelopments. When it is subject to tax, what is the time of supply involved under the GST? What is the taxability of the various forms of consideration that has been paid to the existing members of a society? What is the method of accounting? Revenue recognition, accounting standards, ICDS and guidance notes as applicable to the points under discussion. What are the implications of Section 37 of the Income Tax Act to the subject? TDS under Income Tax Act 1961, inheritance issues, bankruptcy and insolvencies issue, and what is the way forward? What I have done for each of the aspects, I have created the different compartments. So each compartment will be discussed, and at the end of each discussions, I have raised a couple of questions for the purpose of the discussion so that recap becomes easier for whoever is attending this particular session. So when I started this particular topic of society redevelopment, and especially the biggest challenge which I faced, I got to study from both the angles, income tax and GST. So situation was like I was shuttling between a South Pole and a North Pole to understand, are there any similarities or it is totally different? Or is it a vice versa? Can I apply the concepts of income tax to GST or GST concepts to income tax? But let me tell you friends very, very clearly, both are totally different. Objectives are totally different. And wherever possible, one can use as a references of provisions to help each other in the respective laws, but they are independent. So we should try to use only the correlation between two rather than transferring GST concepts into income tax and income tax concepts into GST. With that background, let us start with the basic definitions which are given under the provisions of the income tax. Especially if you look at any particular law of the country, on whatever the topic, definition always are defined under Section 2. So when we look at the definition of a business given under the Income Tax Act, it says business includes any trade, commerce, or manufacture, or any adventure, or a concern in the nature of trade, commerce, or manufacture. Here the use of the word adventure is very, very important, because whatever we are going to discuss, we are discussing from a society redevelopment. That activity is done once in a while. It's not done on a regular basis by the society per se. So even a one-time activity can be considered as a business if there is an intention to sell additional area which can be available to society on account of the society redevelopment. But if no area is sold to the external person, then it will not fall under the definition of a business at all, because then it will be more of a repairs rather than a business. It's a self-construction. But when I compare the definition of a business given under the GST, it says any trade, commerce, manufacture. Look at compare the definition between the income tax and GST. It says the same words. Business includes. Both the definitions are inclusive definitions. So they are just illustrative, and it can envisage more situation than what is been covered under the provisions of the respective definitions. Under GST, it says any trade, commerce, manufacture, profession, vocation, and adventure. Look at the word used, adventure is the common in both. But GST says it includes also wager or any other similar activity, whether or not it is for a pecuniary benefit. And clause B defines any activity or transaction in connection with or incidental to or ancillary to subclause A, irrespective of the volume, frequency, continuity, regularity of such a transaction. So in case of the GST also, one of the transaction in the form of a self-development also can be included in the definition of a business for the purpose of the levy. So here when I would do a comparison of both the definition, can we say the definition provided under the GST law is much wider in terms of the definition given by the law, or the definition given by the Income Tax Act is wider? But if you consider the various judicial pronouncements available under the income tax also, based on the volume, frequency, continuity, regularity of the transactions or one of the transactions, still it has been held to be a business for the purpose of the levy of income under the profit and gains of business or profession. But in GST, profession and vocation is provided under the clause A, whereas under the income tax, it is provided under section as a specified profession under section 44AA, which says which professions are considered as a notified professions and other than that are considered as a non-specified professions. But here one question that comes, being an adventure in terms of the society redevelopment, will it be treated as a business? Whether it is for the pecuniary benefit or it is without pecuniary benefit, or whether it will remain as a capital asset as defined under section 214. And if it is a business income, it will go under the profit and gains of business or profession. And if it is a capital asset, it will go under the category of capital gains, which is subject to charge as governed by the section 45 of the Income Tax Act. Plus, when I look at the books of accounts definition given under the Income Tax Act, it is given under section 2 subclause 12A, which defines what can be called as a books of accounts. But as there is any specific provision under the GST law to where the books of accounts are defined. If you look at the clarifications or press releases which are issued under the GST law, it says that whatever the books of accounts that are maintained for the purpose of the income tax compliances, that can be termed as the sufficient for the purpose of compliance of a GST also. But if I dig more into the provisions of section 35 of CGST Act 2017, read with the rule 56, it defines what are the records to be maintained by the registered taxable person under the provisions of the GST Act. And similar, if you look at the corporate law provisions also, It also defines what are the books of accounts respectively. More or less the definitions are similar. Plus, under income tax, cooperative society is defined under section 2 subclause 19, which says registered under the Cooperative Societies Act 1912 or any other law for the time being in force in any state for the registration of a cooperative societies. When we consider the one more clause given under the definition of a business under GST, provision by a club, society is not a club, but it is definitely an association or a society or any body for a subscription or any other consideration of the facilities or benefits to its member. Society will have a common maintenance area. It will be collecting the maintenance charges from the respective existing members and it will be maintaining. So it will fall also under this subclause E. So even this activities may be considered as relevant, ancillary, incidental or extended activities on account of the self-redevelopment also. Let's look at some very important definitions of GST, which defines the goods, means every kind of a movable property other than money and securities. And services means anything other than goods. So here, if we look at the definition given of business under income tax as well as GST, the definition was inclusive, whereas the definition given for the goods and services under GST, it has not used the words includes, but they have used the words means. It is exhaustive. So if you fall either under the category of goods or you fall under the category of services, then it is treated as a supply as per the provisions of the GST law. But it categorically excludes money and securities from the definition of a goods as well as services. Here one question that comes to my mind, can I treat revenue sharing arrangement as a transaction of money so as to fall under the exclusions of the definition of a goods as well as services? I'm just putting this as a food for thought for the benefit of all the participants. I will touch upon when I come to the subsequent slides where I have touched upon the revenue sharing. But it is just right now food for thought. If I do a revenue sharing bit in case of the society redevelopment, will it be excluded? And if it is excluded, GST, I'm not supposed to register at all. But let's now look at the definition of a very another important definition under the GST of outward supply, which in relation to a taxable person. So outward supply is provided by the registered taxable person. Registered person means the person who is registered under the provisions of GST. Means supply of goods or services or both. Again, here they have used the word means, not includes. Whether by way of a sale, transfer, barter, exchange. Let's hold here for a moment. In case of the society redevelopment, there is a transfer happening of the development right or a land from a society to a builder developer, or barter. Since the building development rights are transferred and person receiving is getting a new flat, it can be covered under the definition of a barter also, or even an exchange also, or any other mode by such person in the course or a furtherance of business. Can we correlate such a similar terms used under the provisions of the Income Tax Act? Similar terms are used under section 45 of capital gains, as per my understanding. But when I read the corresponding definition of inward supply, they have said in relation to a person. For outward supply, it is by a taxable person, and inward supply can be any person who can be unregistered also. So even if the society is unregistered for the purpose of GST, still it can be an inward supply in the hands of a society. Shall mean receipt of goods or services both by way of purchase, acquisition, or any other means. Any other means is very wide to cover any scenario that can exist with or without consideration. So here there is a specific that has been said that even an inward supply can be for a money consideration and or it can be without money consideration. Typically, society redevelopment, there is no transfer of funds in generally from the existing member to the builder developer in a direct manner, unless and until some component of the consideration is worked out between a cash and the kind. And it can be in any proportion, 1% in cash, 99% in kind, or it can be the other way around also. It can be 50-50, 60-40, whatever the proportion is, that doesn't make a difference. So society redevelopment will be the basic, this particular thing. But the moot question that comes to our mind, can the society be termed as a carrying on business as provided as per section 270 being an adventure? Or is it making an outward supply as per section 283 read with section 71AA, which was essentially introduced to overcome the judgment of the Calcutta Club? We will touch upon this, but right now I'm parking this particular food for thoughts. These are the various terms. What majority of the terms which we can say, we can take it from a RERA law. And if it is undefined under the RERA law, we can go to the General Clauses Act and take a suitable, draw our inferences from there. Now let's touch upon some of the foundation aspects. Is society redevelopment prevalent only in India? The answer is no. It is prevalent in USA, China, Hong Kong. This is the reference of the research article of International Journal of Innovative Research in Science, Engineering and Technology. And again, same concepts are prevalent in UK, Canada, Australia, African countries as of now. Maharashtra is the pioneer in the self-redevelopment, whereas Gujarat is on the aerodrome strip, waiting for it to kick off. Very limited projects are happening in Gujarat on account of the society redevelopments. But if we look at the Gujarat RERA Act, it is almost replica of a Maharashtra RERA Act with few changes here and there. So can we say that sooner or later other states would follow the same logic? And if that is the case, look at the professional opportunities which can be available to the members of the profession to encash if they become subject master of this particular topic. Further, Maharashtra Regional Town Planning Act 1966, Development Control or a Carried Regulation 1991, DC rules, Maharashtra Cooperative Societies Act 1960, Transfer of Property Act 1882, Indian Registration Act 1908, or plethora of other property laws that can be applicable to the transaction. But here, when I say a property development, which includes the development also, which can be a new development also, anywhere and everywhere across the country. It is for the purpose of land. It can be for society. It can be for federation. It can be SRS society also. It can be commercial society also. It can be tenanted society also, freehold land, leasehold land, halls, temples, gurudwara, churches, masjid, office and industrial park, godown, warehouses, ports, shipyards, SEZs, heritage buildings, NGOs, trust, schools, and ultra-modern buildings. But in our discussion, whatever the foundation that we are going to discuss, all concepts, basic structure remains the same. Depending on the nature of entity, one has to do the tailor-made agreement constructions according to the needs. And one can always use the references for other kinds of redevelopment that can happen. But in whole our discussion, we are going to discuss only society redevelopment. Typically, a society is a group of people or a group of several members staying together. And since they are staying in a very old buildings, they would like to get their property redeveloped. Or they have a plot of land and they would like to develop that land into a residential structure, which they can use for the purpose of this residence. But why not to go for a new construction altogether? Why redevelopment? One is growing population by leaps and bounds, as it is stated in the public domain. India soon will take a lead in terms of the population as compared to China. When it will happen, only time will tell. Everybody would like to stay in the modern buildings, which are compatible with the social living trends. Everything should be available under one roof. Supermarket, hospitals, swimming pool, football court, table tennis, everything. Whether we use it or not, that's the secondary thing, but everybody would like to aspire that our project has that kind of facilities. Horizontal and vertical developments. It can be done in both the manners, depending upon the area that is available. But typically, look at the prices of the flats today in the public domain. For a 2 BHK, average ticket price in a proper area is not less than 2 crores. Can an average family afford such kind of a price? At least I believe it's very difficult for a person to buy a 2 crore property easily. Plus, there is a dearth of land bank, especially in the metro cities, where the land itself is much more valuable than anything else. Community living and social networking. If you live in a proper society, probably it helps professionally, business-wise, because of the social network that one can build. And plus the government policy support that is given for the society redevelopment. But when we look at the ecosystem of the regulatory and the taxation aspect of the society, government is always there to collect their pie of taxes because of the society redevelopment. Property laws, because of the several permissions required under the property laws, that also forms part of one of the cost for the purpose of the society redevelopment. Since the society is essentially incorporated under the society law, whatever the provisions that are applicable under the society law, they are applicable for the purpose of the society redevelopment. But if you are doing this activity in a systematic manner, accounting and the auditing is also equivalently applicable. And once we talk anything exploited with the pecuniary benefits or a commercial motive, direct taxes or indirect taxes are bound to be applicable. But in general, just to make, if the property is sold before construction, GST is payable, income tax is payable, TDS is payable. But if the property is sold after construction, GST is not payable, income tax will be definitely payable, TDS also would be payable, depending upon, we will touch upon each of the aspects in the subsequent slides. But another angle of society redevelopment, essentially the foundation of any society redevelopment is a transfer of development rights. And this can be provided by the government also. If they acquire a plot of road from the owner, and in turn to compensate, they may issue the TDR certificates to such a owner of a landowner because of the requirements of developing that particular area. Or there can be changes in development and control regulations, and because of which the TDR is generated, and because of that TDR certificates are issued to the society or a landowner, as the case may be. Or a society may have their extra FSI because plot of land on which the society is existing is quite huge. They have not utilized the full FSI. So society redevelopment by a transfer of development right becomes very lucrative for the builder. And if landowner or a society gets TDR certificates because of the reasons which we have discussed, because of the road widening or acquisition of the compulsory acquisition of the road or the shops or whatever the reason is, and if society doesn't have extra FSI, then a builder developer may use the top-up TDR which are given by the government, which can be used for the developing the extra commercial premises or a residential premises, as the case may be, or it can be any other reason. So when I look at TDR, is essentially infrastructure transition. Maharashtra town planning defines the development right means a right to carry out a development or to develop a land or building or both, and shall include. Look at the word include. Again, it is an inclusive definition. Transferable development rights in the form of a right to utilize floor space index of land utilizable either on the remainder of the land, partially reserved for a public purpose, or elsewhere. So even if the government feels construction can happen on the public premises, any park which are reserved for the purpose of the public, they can do it if it is in the interest of the development as the final development control regulation. Typically, when we look at who are the stakeholders that are involved in the society redevelopment, which is the society, which is the member, builder developer, project management agency, promoter himself, or society can do the self-development. There can be new buyers, and government is always party to every transaction invariably. Society can have a plot of land, or it can have a dilapidated buildings, and which can be converted after the development. It can convert into the posh buildings as the image is on the right hand side of the presentation. When we look at the broad structure of a society redevelopment, it starts with the proposal. In proposal stage, the society is typically required to have the conveyancing experts who are experts on the property law, on the document drafting. They can be solicitors, advocates, or if there is an in-house person available in the society, they can be, but experts are definitely required. It starts with the various proposal by inviting the tenders, which are discussed in the common society meetings, and it is approved. After the proposal is approved in favor of any particular builder developer, transfer of TDR or development rights or a FSI is done by way of a development agreement, which is subject to stamp duty payments as applicable, because this stamp duty is a state levy. And once these documents are done, various municipal permissions are obtained for the purpose of the rebuilding the new society as per the new structure. And typically it is in the form of, it starts with the IOD, commencement certificates. And as and when the structure is complete, builder developer will construct that particular building. And once the completion is done, occupation certificate, completion certificate, or a first occupation, as the case may be. Typically, possession can be given only after the receiving the completion certificate or occupation certificate. But looking at the practical realities, even a first occupation is given based on the partial occupation certificate obtained from the municipal authorities. And possession can be given to the both existing members as well as the new members, as the case may be. But when we look at the society redevelopment, we need to have the feasibility reports in hand, credit worthiness of the contractors, as well as the builder developer who is involved for the purpose of the society redevelopment, whether the legal title to the property is clear or not. Without clear legal title, society redevelopment technically cannot happen. But one more thing that is to be done, as I understand from my study, almost 70 statutory permissions are required for the purpose of society redevelopment. So society is always advised to keep a copies of each such permissions for the purpose of society records. And since the typically any redevelopment may take anything between 3 years to 5 years or 10 years, depending. Surety has to be obtained from the builder development based on the each stage of construction in the form of a bank guarantees. It acts as a support. Tomorrow, if a builder developer makes a default, then society can encash such a bank guarantee and proceed with the society redevelopment on its own, or they can hire a new contractor. Structural approvals, quality controls, regular monitoring, legal compliances. And once the society redevelopment is done, property records also typically needs to be updated with the changes that happens in terms of the area, property number, and so and so. And with that, possession and the final closure of the society redevelopment. To say it is very easy, but it takes ages to complete the society redevelopment. But here one more, let's look at how the compensation happens to the members. It can be new apartment with the extra area. And for such, stamp duty would be payable, including the registration charges as per the Stamp Duty Act prevailing in each of the state. Sometimes corpus is also paid to the members as well as to the society. Hardship allowance is also given to the members, or a permanent alternative accommodation cost is also paid. Shifting allowances is also given, and some other concern. But let's look at some other amenities if they are provided by the builder developer to the existing member, say air conditioner, fridge, modular kitchen, car, or a furniture, if it is lucrative for him. One question that comes to my mind, will it trigger the provisions of section 56(2)(10) as a deemed gift given by the builder developer to the each and every member. We will examine this angle in the subsequent presentation when we discuss that particular slide, but right now I'm parking this particular thing. So whatever we have seen on the left-hand side, it is a part of the construction cost for the builder, besides the actual construction cost of demolishing the structure and recreating the new structure with the government permissions, legal compliances cost, contingency costs, which can suddenly come up because of the changes in the governing law, plus his profit, which he can derive from the sale of a free area sales, which he can get because of the society redevelopment. Because no builder developer will work without intention of making money out of the society redevelopment. But only one difference, which if a society goes for a society redevelopment, then the builder developer profit is not included as a part of your cost of the total project. But here one more aspect that has got to be kept in mind when we are doing a society redevelopment from a conveyancing perspective. If it is a tri-party agreement, especially it is treated as the builder developer is providing a construction services to the existing member or a landowner, and this all issue created because of the circular which was issued under the service tax regime, and that started creating the dispute in case of the joint development agreements. Now more things from whatever we are going to discuss, it will be from 1st April 2019. But typically, if the land is transferred to the builder developer by the society or a landowner by a conveyancing, then instead of tri-party agreement, there will be only two-party agreements. So that will decide the rates of taxes that are applicable under the GST provisions because of the under construction or after construction. So that angle one has to keep in mind, how the documentation is done. Consideration can be paid in the form of a cash, which is the outright purchase. If that is the case, it becomes a very simple transaction. It will covered as a transfer of asset, capital asset. And if there is a transfer of capital asset, capital gains is payable under the income tax provisions. But if it is a transfer of a land, then GST is not payable because it is excluded as a definition under Schedule 3 as not a supply. But it is a combination of a cash as well as the kind, that is the area. So in that case also, IT and GST both are payable, but point of taxation is shifted from the year of execution to the year of receipt of occupation certificate or a completion certificate or first occupation as per the notifications which are issued in the last week of March 2019, which has completely changed the way real estate GST transactions are to be treated now. But here, let me touch upon if it is revenue sharing model also. So it is consideration that is paid to the landowner or a society in three forms: cash, kind, and revenue. Or let it say only revenue. So can I say revenue sharing model, I will treat that as a money transaction and I will treat out of the exclusion of GST? Answer is no. There is only one way which I could think the revenue sharing will not attract the levy of GST, which I will discuss in the next slide. But rest all, everything remains the same. And these are the various notifications which are given which we will be discussing in the subsequent slides. Let's look at the structure of the cost before we touch upon the revenue sharing. TDR cost, extra benefit cost to the existing members, and society on account of the redevelopment. Without that, no society redevelopment is possible. Legal permission cost, ancillary, incidental, construction cost plus contingency, taxes, direct and indirect, and margin. And typically margin, when we discuss, it is always post-tax. That's why I included taxes, direct and indirect both. In society redevelopment, only margin will not be there, rest everything will remain as it is. But when I do a comparison of a builder society redevelopment or a project management agency redevelopment vis-a-vis the society self-redevelopment, we find builders have a expertise or professional skills or technical skills to construct the building in much better manner as compared to a society who can construct such a building. Typically, we have oceans of brain in the society members. And typically, even if there are 50 members in a society, I don't think even 50 members agree to any proposal unanimously to execute. So it is always better to go for the builder development. Committed timelines. Builder can always complete the construction within the timelines. Do a society will have a committed team members? Initially they will have, and thereafter they may not have. So again, that creates the issue in the society redevelopment. Society will have a limited resources to build the building. If it is a well-established building, enough corpus, then it may not have, but typically society funds are very, very limited. Statutory permissions, every society may not be expert of seeking, knowing what permissions are required. So expertise are required. Time and dedication, builder can provide, but society may not be able to provide. Permissible FSI. Only advantage that I see in a society redevelopment. If society does self-development, they get extra FSI as per my understanding. I'm not the subject expert on this FSI permissions or all, but as I have understood, society will get the additional FSI if they do it. Housing finance facilities challenges. If it is a reputed builder getting a housing finance, it's very easy. But if the society is doing, chances of getting the housing finance are at times can be difficult, depending upon the various reasons. But after considering all this, still the society decides to go for a society redevelopment, then GST registration and the compliances have to be done. And everybody knows how simple the GST compliances are. So that acts as a discouraging point for everybody to do the GST registration from a society redevelopment perspective. And that's why, looking at the holistic view, builder redevelopment is much more famous, or a project management agency redevelopment is much more famous as compared to society redevelopment. Few societies are doing a society self-development, but only success time will tell. Right now, it is too premature to say whether society self-development is a success or not. Now, let's look at I had touched upon if I go for a revenue sharing arrangement. Revenue sharing arrangement, if I do by way of a joint venture or a special purpose vehicle. So if joint venture or SPV is a separate legal identity as compared to a landowner or builder developer, where both come together as a partners, they build the redevelopment of anything that is applicable. And if they draw their remuneration as a part of share of profit, then probably such a share of profit will not be subject to levy of GST at all. Otherwise, any kind of a revenue sharing arrangement that we do would be subject to GST. So this is the basic thought which I had on the topic. Now here there are the various notifications which essentially governs society redevelopments. It starts with the notification number 3, 4, 5, 6. And notification number 3, 4, and 5 of 2019 have amended the rate notifications issued in the chronological order 11, 12, and 13, which governed the GST provisions from 1st July 2017 till 31st March 19. So when I look at the notification number of 3 of 2019, it prescribes the rate of GST for residential and commercial. And it also provides the guidelines for the valuation of a construction services when provided against the transfer of TDR. Notification number 4 of 2019, it exempts supply of services provided by our TDR for the construction of residential premises. Remember the word only for residential premises, it is exempt. If it is for commercial premises, there is no exemption. In respect of the entire consideration or a part consideration has been before issue of OC, CC, or first occupation, and prescribes the mechanism to value development right in certain situations, because government has a right to prescribe the conditions or situation how the valuation can be done. Notification 5 of 2019 provides for the taxability in respect of the services provided by our development rights on RCM basis in terms of which liability to pay has been cast upon the promoter. So promoter can be builder developer, or it can be landowner, or it can be society also, depending on the model that one adapts. Notification 6 of 2019 provides promoter to be registered person. So promoter will always be a registered person for the purpose of GST. If he is not registered, then it can be deemed that he is not a promoter. But again, a promoter definition, we need to take it from RERA also. To pay a tax on supplier of development rights and on the consideration services against such development rights. Time when the tax is to be paid in respect of the services mentioned in scenario clause 1. So this is the broad structure. But here the one question that comes to everyone's mind, why RCM on the builder developer or a land promoter? The reason is, if government has to recover taxes from each existing member of the society, it would be very difficult exercise for the government. So that's why the burden has been shifted instead of forward charge mechanism to reverse charge mechanism. That's the logic as I understand from my subject. But here the moot question that comes. If a society's income, earning the income from society redevelopment, will it be treated as the income from other sources or a profit and gains of business? Especially when I read section 56, section 28 of the Income Tax Act, as well as section 7, which defines the scope of supply of the GST Act. If it is with the intention of self-redevelopment and with the no intention to sell to the external persons, then whatever the income society will earn, that would be covered as the income from other sources as per the justifications. Principle of mutuality still holds for the purpose of society. Out of mutuality, there cannot be subject to tax. But the moment you have an intention to sell to the external person other than the existing members, then you are shifting from in the category of a business, and which will be governed by the profit and gains of business or profession. And once you are governed by the profit and gains of business, GST registration is automatic if your threshold limit is exceeding 20 lakh rupees. Especially with the recent judgments which are given by the Supreme Court on in case of the ODA and the new Noble Education. If they do self-development, whether GST provisions will trigger? Yes, it will trigger if it is with the intention of selling it to the external persons or taking the advantage of a commercial or the threshold. This judgment has to be studied in a very deep manner to reach any particular conclusion. But since they were recent, I will just put it as a food for thought. Here, one question that comes: if a person, say, Nilesh ji of Pune CPA Circle is buying a residential premises for 5 crore rupees. So it is a non-affordable housing. He is paying 5% GST on 5 crore. For acquiring such a premises, can he claim the input tax credit if he is registered for the purpose of the GST? The answer is very, very simple. He cannot claim. The reason is twofold. One is it will be covered under the block credits, section 17(5) of the GST. Plus, ultimately, the sale of property is not subject to GST, so ITC is not eligible. But instead of, say, residential property, if a company is acquiring the premises for the commercial use, can they claim the ITC? Again, the answer is the same. There is no change. ITC is blocked under 17(5), as well as the ultimate office premises cannot be sold. Though some builders say, especially when you are buying a commercial premises, you can claim the ITC. These statements are made in the public domain, but that is wrong. But again, if the property is constructed with the intention by the company, LLP or a firm with the intention of letting it out, can they still claim the input tax credit, especially considering the Safari Retreat judgment? In my personal opinion, it will be still fall under the block credits. I don't agree to the judgment of the Safari Retreat. We are waiting for the final verdict to be announced by the Supreme Court on the Safari Retreat judgment. If they rule otherwise, I will accept that with the humble thing, it is eligible, but chances are they will rule against the plaintiffs. Whether cross-border transactions are applicable to the cooperative housing societies, firm or LLP or a company, society will apply, because nowadays there is a fashion to invite the architects and the landscape designers from the overseas. And if they are providing services to the society, then cross-border transactions will apply. Section 195, Section 9090A, compliances have to be done, and it will be treated as an import of service, because the conditions required for the import of services as per the IGST Act are satisfied, and RCM would trigger. Society will pay the RCM as applicable at the rate of 18%, which can be claimed as an offset against the output to tax liability of the society, either at 1% or a 5% or a 12% or 18% or 1.5% or 7.5%, as the case may be. One more thing, as a RERA extension, if a society is redeveloping the property, which is not intended to sell to the external person, then RERA registration is not required. But if you have an intention to sell to the external person, then RERA registration is a must. So this is the basic foundation. Let's look at some of the income tax concepts. When we look at the definition of a assessee as given under section 2(7), again it is an inclusive definition. In 1922, individual HUF company and firm were considered as an assessee. In 1924, the concept of association of individual was introduced, which was replaced by the word in 1939 by the association of person, and which is beautifully defined by the Supreme Court in the Indira Balakrishnan judgment, which, for at least to my understanding, that is the first judgment which defines the association of persons. But now income tax uses the word only association of person or a body of individuals, plus section 219 defines the cooperative housing society and any other categories. But when I look at the definition of a GST, section 2 subclause 84 again has an inclusive definition. It defines an AOP or a body of individuals, whether incorporated or not, in India and outside India. There are many people who have a view. If say there are 100 members in a society, they will open a joint bank account in the name of 100 persons, and they will do the society redevelopment, which will not attract the GST levy. My humble view is they will be considered as a unincorporated or incorporated AOP or BOI, and they will be proceedings can be initiated under the provisions of GST. Society is defined as per the Society Registration Act 1860. Trust, and so if you compare the definition of an assessee and a person under GST, it is more or less the same. There is hardly any difference, very limited difference. Property can be movable or immovable. It can be in the form of money, tangible things. Because if we have a physical property, we can touch that particular property or we can see it with our own eyes. So possession of the property can be absolute or it can be qualified, especially when there is a qualified possession of the property. If that qualification is vacated, then the right of the property is lost. And there can be another kind of a property which is intangible property, which are in the form of a TDR, FSI, or a development rights. And such is recognized on the binary property law also, which says property means property of any kind, whether movable or immovable. This is just for the discussion's sake. And property is relevant with reference to all the definitions that we will discuss in the subsequent slides. Now let's look at some of the GST concepts before we proceed further. Section 7 says all forms of supply of goods or services or both, such as sale, transfer, barter, exchange. So transfer and barter is common in society redevelopment. So that will be covered under the clause 1 also. But can we say so society is doing a business or it is incurring such expenses in furtherance of business? After the introduction of AA clause, the activities of transaction by a person other than individual to its members or constitutions or vice versa for cash or a deferred payment or other valuable consideration, the option of not getting covered under the definition of a supply and avoiding the GST registration is minimized completely. Various schedules are given, we will see in the subsequent slides. But before we go into the schedule specific, let's try to understand the basics definition, which is a composite supply. Section 230 defines composite supply means a supply made by a taxable person to a recipient comprising 2 or more supplies of goods or services or both or any combination thereof, which are naturally bundled and supplied in conjunction with each other in the ordinary course of business of one each. It's a principal supply. So here in society redevelopment, can we say TDR, corpus, funds, additional area, hardship allowance, permanent alternative accommodations, shifting allowance or any other, or white goods, which we have seen in the earlier sheet. Can we fit into the definition of a composite supply? And if that is the case, if we feed that into the definition of a composite supply, but to fit that into the definition of a composite supply, we need to understand what is principal supply. Principal supply means the supply of goods or services which constitute the predominant element of a composite supply. So in society redevelopment, when we look at building redevelopment, isn't it can be termed as a predominant element of a composite supply? In my view, it is a predominant element. And so all the compensations that are paid to the existing members on account of the society redevelopment, they can be covered under the definition of a composite supply. And these are the examples which are given under the GST Act. I'm not touching that, but basic angle is this. But there is one more kind of a supply, mixed supply, which is again defined under section 274, means two or more individual supplies of goods of supply services. So in society redevelopment, TDR is given, extra area is given, corpus is given, hardship allowance is given, alternative accommodation cost is given, shifting allowance is given, white goods are given, or any other things are paid. Can we say they are individual supplies? And if it is an individual supplies, will it attract the highest rate of tax? Say, for example, a car is provided free to all the society members on account of the society redevelopment. So what is which definition that we will seek to apply for in case of the society redevelopment? In my humble view, I will go with the definition of a composite supply, and all other components of the compensation that are paid to the society member is ancillary, incidental to the predominant supply of redeveloping the building. We will touch upon this angle little later. Let's look at the schedule 1, which says ki activities to be treated as a supply even if made without a consideration. So new flat that is given to the society member, it is without consideration. So will it fall under the definition of schedule 1, which is forming part of the GST Act? Because, or can it be treated in any of the categories that are covered as provided under that particular section? Let's look at the schedule 2, which says activities will be considered either as goods or supply of services. Goods, more or less, I think most of us will agree that society redevelopment is not a goods, but it is a service, especially the work contract service, where there is a transfer of ownership of material and services in the favor of existing member on account of the society redevelopment, which is defined. There is no dispute on that thing. So construction services as existed under the service tax regime, same continued under the GST regime. So it will cover under the schedule 2 if it is a under construction services provided on account of the society redevelopment. Schedule 3 says activities covered under schedule 3 which are neither supply of goods nor a supply of services and would not be included in exempt supply. And we are essentially considered with the sale of a land, sale of a completed building, which is covered under the schedule 3. So anything that we are selling after receiving the occupation certificate or a completion certificate or a first occupation, I would like to touch upon, put a question mark for the first occupation. Will it be considered in Schedule 3 supply? It can be considered. And essentially, all of us have the view, if the supply is meant for business, then only it can be subject to levy of GST. But looking at the amendments carried out, even a supply by the society where the intention is not of making any profits, or it governs on the principle of mutuality, GST is applicable as per the notifications and the clarifications issued by time to time. But one thing that one has to be clear, if it is not a supply, there can be no chances of levying any GST. So if I go back to my earlier discussion of revenue sharing, and if my transaction, I put it as a money transaction because of this SPV that I have formed for the purpose of the society redevelopment, I can say it is neither a goods, neither a service, but it falls under the exclusion. So no GST will apply. And if it is a notified exempted services, then also I can say it is exempt or a nil rated or a non-taxable supply based on the notifications issued. But if the supply is done within the state, then we know what levies we charge, CGST plus SGST. And if it is interstate or a cross-border, we charge IGST. Typically for the purpose of society redevelopment, CGST and SGST will trigger because it is linked to a property. If it is a single supply, then whatever the tax rate applicable to single supply, that will apply. But if it is a composite supply, then whatever the rate that is applicable to principal supply rate, same GST rate will apply to even an ancillary services provided. And if it is a mixed supply, then the highest rate of tax of GST will apply. This is the board thing. Let's look at some history of society redevelopment. When I say history, it is history. It is not applicable today, but it is only for the purpose of the discussion. We are taking up this particular thing. Under income tax, as per the old provisions, as soon as once signed the documents of transfer of land or transfer of land for the purpose of the development, income tax levy attracted based on that particular judgment, and that is been given in the Chaturbhuj Dwarkadas Kapadia, Bombay High Court, and Jasbir Singh Sarkaria, Authority of Advanced Ruling, New Delhi. But then Punjab and Haryana High Court said in the subsequent, when the matter went for a dispute, if an agreement is registered as per the provisions of the Registration Act 1908, especially referring to section 17, then only such transaction is subject to levy of income tax. Earlier, what was happening, TDR agreements were executed, which were not registered also, on a 100 rupees stamp paper or a 10 rupees stamp paper, as the case may be. So Punjab High Court said nothing doing. If it is registered, then only it is subject to tax, otherwise no. So it is not subject to this. Similarly, part possession given on account of the performance as per section 53A of Transfer of Property Act, even that is satisfied by way of a agreement which is executed, which is registered, then also it can be subject to tax. Now let's look at under the indirect tax. Entry 49 of list 2 of 7th schedule only allows state to impose a tax on land. That is Article 246. Most of us would be knowing that every state has got its own stamp duty law. And this is how the state has derived the powers to tax, a levy of tax on land. So here under GST, when we are doing a construction services by way of a joint development agreement, if a land is part of that particular thing, can a tax be levied by the government? Because under the service tax regime, it was clearly provided that activity of transfer of title in movable property is excluded from the definition of a service as per section 66B of Service Tax Act 1994. And in fact, immovable property was never defined. So one had to rely on the General Clauses Act definition to reach a conclusion. There was no specific provision qua TDR prior to 25th January 2018. Notification was issued on that day to tax the levy on the TDR. But in my humble opinion, till 31st March 2019, there is no levy of GST on TDR at all. TDR is taxable only from 1st April 2019 in view of the notification number of 4 of 2019. Department will always try to create the litigation, but it is not subject to levy. Chheda housing judgment also said development rights being a benefit arising from a land must be held to be an immovable property, and once it is an immovable property, it amounts to transfer of title in immovable property, which is outside the levy of services altogether. So though they are builders, DLF commercial, there is a Supreme Court judgment of BB Jan or something, I don't remember the exact citation, but even that can be relied on. And DLF was the classic example of government wanted to tax the transaction. One should read the facts, but this is history. So we are concerned, now we will touching only what is applicable from 1st April 19. Let's look at the definition of a transfer as given under the Income Tax Act. But before we go to the definition of a transfer, let us understand what is capital asset. A property of any kind held by an assessee, whether or not connected with his business or profession. So capital asset can be both for personal as well as business or a profession as the case may be. Section 247 says transfer in relation to a capital asset includes, again an inclusive definition, sale, exchange or relinquishment of the asset. So in society redevelopment, society is giving a right of redevelopment and it is relinquishing the right in favor of the builder developer. So will it be covered under section 45(1)? On a plain reading, it looks it will get covered. Why I will say? Because there is a new section which has been introduced called section 45(5)(a), which is applicable from assessment year 18-19. Because of that, transaction of society redevelopment will not fall under the category of 247(1) or extinguishment on any rights. So if we treat development rights as a right in movable property, even that can be covered under the subclause 2. Subclause 4, in case where the asset is converted by the owner thereof into or is treated by as a stock in trade of a business carried on by him, such conversion or treatment also will be treated as a transfer, and that is governed by section 45(2). Even extinguishment of the right will cover under the 45(1). But let's look at the definition of a supply, which we have just seen in the previous slide. Sale, transfer, barter, exchange. There is no sale involved, but there is a definitely transfer involved, barter involved, and the exchange involved in case of the society redevelopment. Agreed to be made for a consideration by a person in the course or furtherance of business. Consideration is in the form of a transfer of development rights. That is for the valuation is provided. How we will reach that valuation, we will touch upon in the subsequent slides. And the activities of AOPs. And that change essentially came because of the Calcutta Club judgment, which was on the article of 369 2A, whereas GST is governed by the article 246A, 269A, 366 12A. Before I proceed further, the definition of a goods and services given under the Constitution of India, goods have been defined as an inclusive definition, whereas services have been defined as an exhaustive definition. That is a basic difference between two. And that's why when we look at the definitions given under the GST Act of goods and services, they have used the word goods means, services means. This is what I could understand. Here, clause 5 is very, very important from a society redevelopment perspective. Any transaction involving the allowing of the possession. Transaction here, it refers to a transaction of a self-redevelopment. Allowing, you are permitting a builder developer to enter into your premises to do the building construction by parting the possession of a movable property to be taken or retained in part performance of the contract of the nature referred in Section 53 of the Transfer of Property Act. And this is essentially Section 45A, which has provided for the deferment of the tax to be paid. Because typically, let us take an example. Person A is having a land worth 100 crores. And if it transfers because of the society redevelopment, and if it is covered under the definition of 45(1), he will be liable to pay the tax of 100 crores, income tax on a long-term, as a long-term capital gains, depending on the period of holding. On 100 crores, he will be asked to pay 20 crores plus surcharge, plus cess, and everything else that is applicable. But that person will only have a land. If he doesn't have the funds, how will he pay the tax? And that is with that difficulty keeping in mind, this clause 5 was put and section 45(5)(a) was introduced from assessment year 1890. And even clause 6 is also similar, where there is an indirect transfer of the shares of the society. Here, I'm repeating the definition of a composite supply. Here, component of compensation is paid in cash, which is the paid in the form of a corpus, in the form of a alternative accommodation cost, hardship allowance, shifting allowance, and new area, which is in kind. Can we explore the option of treating under the composite supply? In my view, it can be definitely be a composite supply. My humble view. Mixed supply, if it department may try to go into the mixed supply thing, but it is a composite supply because predominant intention is the building construction. Immovable property is defined under section 269 UA of the Income Tax Act. An explanation transfer includes shall deem to have always included disposing of or parting with an asset any interest therein. Mark the words interest therein. So when our interest by about development rights is also covered, absolutely or conditionally, voluntarily or involuntarily, by way of an agreement. And which will arise because of the transfer. So if there is a transfer of disposal of a business, can we say in case of the builder developer is transferring the constructed flats without consideration to the existing members so as to fall under the schedule 1, and because of the schedule 1, will it be covered by way of a valuation provisions as provided under section 15 of the CGST Act? The answer is yes. But when? That we will touch upon. Schedule 2 construction services, there is no dispute on that. If it is a sale of a land or a sale of a completed building, it will be out of the supply. But can a part of land or a part of building be considered under the schedule 3? Or it has to be full land, full house? In my opinion, whole includes part, bigger includes the smaller. And because of that, even a part of land or a part of building also will be covered under the schedule 3. Especially if there are many times agricultural land, which can be a rural agricultural land or a urban agricultural land, that is transferred to a builder, and later on builder converts agricultural land into a non-agricultural land for the purpose of the construction. So here land records classification plays an important role. And because of the redevelopment, if there is, it means that there is a transfer of agricultural land in society redevelopment, considering the area parameters as provided under the Act. It will not be subject to tax under section 45(1) because it is not a capital asset at all. But if it is an urban agricultural land, then it will be subject to tax. But it will be an urban agricultural land means which is not a rural agricultural land, but it is used for the agricultural purposes. In that case, we can use the reference of 45(5)(a) to save the tax, rather deferring the tax. It is not the saving the tax, but deferring the tax. This is the basic thing. Here, section 214 says capital assets mean property of any kind held by an assessee, whether or not connected with a business or profession. For the removal of doubts, it is hereby clarified that property includes and shall deem to have always included any rights in relation to an Indian company. Property we have seen earlier in the definition includes movable and immovable. So even our rights will always be covered. Long-term capital and short-term capital definition we are aware. For a immovable property, now the period of holding is 24 months. If it is more than 24 months, long-term. If it is less than 24 months, it's short-term. Can we say by handing over the possession of the property, it will be treated as a transfer? If your agreement that you draft categorically says कि We are allowing the right of constructing the building to the builder developer, but we are not transferring the ownership of the land as provided under section 247 of the Income Tax Act. Then it will not be subject to tax, but it will get deferred by way of the beneficial provisions provided under section 45(5)(a). So conveyancing will play a very significant role in drafting the redevelopment agreements in the interest of the society. So for that, we need experts who are experts in the society redevelopment. Similarly, conveyance antecedents what are drafted in the agreement will determine whether there is a transfer of ownership or not. If there is no transfer of ownership, the transaction cannot be subject to tax at all. But typically, in all joint development or redevelopment cases, conveyance happens subsequently. But here one more question people say, can a society members contribute to the corpus fund for doing the redevelopment of the society in future? Whether such corpus contribution by the members would be exempt from the levy of GST. In my understanding, a member cannot contribute towards the corpus of the society. That is not permitted. And even if it is, let us assume it is permitted under the Society Registration Act, such corpus will be subject to levy of GST because it will be defined under the supply. Can a society member pay the advance deposit for the purpose of the society self-development if they decide to go? As I understand from the society law, if you want to take the advance from the member, you need to take a register permission and then only advance can be obtained from the members. Otherwise, it is not legally permissible. And even if it is, say, permitted, that advance will be treated as an advance towards the services of society redevelopment and it will be subject to levy of GST. Or for example, builder developer has given a substantial corpus to the society. Can it distribute amongst its members? In my humble view, though I am not an authority on the society law, such distribution is not permissible. Can society distribute dividends? Yes, it can distribute, but there are a lot of registration formalities have to be done. But dividends can be done. One has to examine under the society law. Can a society go for a redevelopment without conveyance in the society name? Answer is no. Conveyance is a must. But due to some reasons, if the conveyance is not possible, then society has to go for a deemed conveyance and then only it can go for the redevelopment. Otherwise, it is not possible. If society is depositing the corpus money in a FDR with a cooperative bank or a nationalized bank with the intention to reduce the maintenance expenses in future, will such would be taxable or exempt in the hands of society? If it is a cooperative bank, then it is exempt. If it is nationalized bank, it is taxable. That is possible, but it depends how the structuring is done. Can we take a break for 5 minutes now? Hello?
Yes, sir. We can have.
Yeah, so 5 minutes break we are taking. Thank you. क्यों लगे?
GST builder versus redevelopment में भी कर सकते हैं।
क्यों लगे?
GST तो आपको ऊपर ही चाहिए यानी।
Nitin sir,
But how is it going?
I'm doing well.
Nitin sir, you can mute yourself.
Hello,
Yes, sir.
can we start?
Yes, yes. Sure.
Okay. I hope members are finding it to be interesting.
Definitely, sir.
So here now we start with the concept of consideration. So all of us know very clearly that a contract without a consideration is invalid or it is a void ab initio. And that is the maxim which is provided by the Indian Contract Act, which most of us must have studied at the time of our CA exams, and thereafter hardly anybody studies. But a contract is also a legally binding agreement which governs the rights of the parties to the agreement in the contractual relationship, and contract will decide what one should perform and what one should compensate for in view of the services or the contractual terms as provided. But there is something called under the Indian Contract Act, it says that even oral promises can be considered as a valid contract. But if we do a society redevelopment by an oral contract, will it support a defense in the if any litigation arise in future? In my humble view, only binding documentation will help. Celebrated judgment of Supreme Court in Tulsidas Kilachand said that there should be adequate consideration and not a good consideration for the purpose of any particular transaction. And again, followed by the another judgment of His Highness Sir Harinder Singh, which said that adequate consideration, denote consideration other than a mere love and affection. So if it is a love and affection, probably it will be treated as a gift, and then the section 56(2)(10) will trigger. But if we look at the proviso of various sections that are introduced under the Income Tax Act, which discourages the transactions to be done in cash, but the encouragement is provided for transactions executed in check, electronic forms, ECS, NEFT, RTGS. And correspondingly, one has to do a disclosure in the ITR, and considering the electronic format of transaction, certain benefits are given under the presumptive system of taxations also. And if I look at the reference of consideration under the other sections which are of the Income Tax Act, as I came to know, section 50C, 50CA, 50D, 43CA, 43C, section 45, 269 UG and UH, or section 180A. But section 231 of GST defines the consideration. And again, it is in relation to supply of goods or services, or both includes. So again, it is an inclusive definition. Any payment made or to be made, whether in money or otherwise. So without consideration will be covered in the otherwise, in response to, or for the inducement of the supply of goods or services. Builder is induced to make a profit by way of doing a society redevelopment. That will cover here, whether by the recipient or any other person, but shall not exclude, shall not include, not exclude, any subsidy given by the government or a state government. Here, one food for thought. If a TDR is allotted by the government or on account of the changes in DCR rule, Can we say it is a government subsidy to be excluded from the definition of a consideration in the hands of a society so as not to pay GST? The monetary value of any act or forbearance, whether by the recipient or any other person, but shall not include any subsidy given by the central government or a state government. So subsidy is common in both the clauses. Can I take that stand? In my view, since these TDRs are allotted on account of the town planning measures, and with the intention of the transformation of the landscape of the city or the area as envisaged by the government, it can definitely be termed as a subsidy, and it will not form part of the consideration in the hands of society when TDR is allotted to the society. And deposit is always also excluded unless it is offsetted in future. At that time, it becomes part of this. But we need to always read any kind of a definition of a supply consideration, always refers to the schedules which are provided under the CGST Act, because in which schedule it will fall, that will determine the levies as applicable or whether taxable or not taxable. Let's look at the section 45(1), which is more or less known to everybody. 45(2) is for the conversion of a individual personal asset into a business asset, whereby the tax liability is deferred to the year in which that stock in trade is sold by the taxpayer. Consideration remains the same. There is no change. It's only for the academic discussion. But again, this clause, let's read very slowly. Notwithstanding anything contained in subsection 1. So section 45(1), which we talked about the sale, exchange, transfer, or clause 2 talked about the relinquishments of the rights, that will get excluded if you fall under the category of 45(5)(a), where the capital gain arises to an assessee being an individual or a HUF. It is applicable only to an individual or HUF. So for a company, LLP, firm, AOP, body of individuals, 45(5)(a) doesn't apply from a transfer of a capital asset. If it is a asset transferred is a capital asset, then only 45(5)(a) will apply. For example, it was the sale of an agricultural land, 45(5)(a) will not apply. If it is a sale of a vehicle, personal vehicle, then also 45(5)(a) will not apply. So one has to be very, very clear with the definition of a capital asset in mind. Ki if it is only transfer of capital A, then only 45(5)(a) is triggered. Being land or building or both. But land, building or both also includes rights in land or building, as we have discussed in the earlier slides. Under a specified agreement means the agreement which is registered. If it is unregistered, then it is not a specified agreement. The capital gains shall be chargeable to income tax as the income of the previous year in which the certificate of completion for the whole or part of the project is issued by the competent authority. Competent authority is normally the local authorities for the purpose of section 48. Stamp duty value on the date of issue of said certificate, that is the occupation certificate or a completion certificate of his share, being land or building or both in the project, as increased by the consideration received in cash. For example, if the value of the land is say 2 crore rupees, cash consideration received in addition to crore is say 2 crore rupees, then the purpose of 45(5)(a) consideration will be considered as 4 crores, not 2 crores, as reduced by the any other expenses relevant for the purpose of the transfer, which is the capital gains concept, shall be deemed to be the full value of the consideration received or accruing as a result of transfer of capital asset. And this is what the 45(a) is essentially is all about. But under GST, if I look at the notification number of 12 of 2017 of June 2017, serial number 41 says, services by way of transfer of development rights, herein refer as TDR or FSI, including additional FSI on or after 1st April 19 for a construction of residential apartment by a promoter in a project intended for a sale to the buyer wholly or partly, except where the entire consideration has been received after the issuance of completion certificate where required by the competent authority or of its first occupation, whichever is earlier. So this can always give us a support. Key transactions of TDR which are executed prior to 31st March 19 is not subject to levy of GST. Secondly, TDR should be meant only for residential purposes. If they are meant for a commercial purposes, it is upfront. GST is payable upfront. Competent authority after its first occupation, whichever is occupied. So let's look at the word here. Also, they have used the word competent authority. Under 45(5)(a) also the competent authority. So this is a similarity. They have used the word certificate of completion, and here they have used the word completion certificate. Are they same terms or they are differing terms? But they have put one more condition under GST, first occupation also. But that is missing in 45(5)(a). So here, what happens? Typically, in case of the society redevelopment, if there are unsold flats post receipt of the occupation certificate or a completion certificate or first occupation, GST would be payable by the builder developer or a promoter as defined under the RCM basis based on the certain mechanism formula prescribed. We will see the formula in next couple of few minutes. But moot question is ki under income tax, only certificate of completion, which is we know as an occupation certificate, is referred, whereas GST is referring to occupation certificate, completion certificate, or a first occupation. By the basic differences. The basic differences, every state has a different procedure of building redevelopments or building developments. Some states provide CC first and then followed by the OC. Some states provide for a OC first and CC later. But GST has taken either of whichever is earlier, because government wants their revenue to be collected first. That is the whole what all logic it appears to be. But here one more situation can arise. If a existing member is transferring his right in share of the project before receipt of occupation certificate or a certificate of completion, can he still enjoy the benefits of 45(5)(a)? The answer is no. If he transfers his right in the property, he will get out of section 45(5)(a), but he will be covered by 45(1) and the income tax would be applicable accordingly. But what will happen to such a transaction under the GST? Since the builder will not pay GST because builder has not received the occupation certificate or a completion certificate or a first occupation, then what happens? Will a existing member will pay the GST? We can take a support of the press release which was issued on 13 July 2017 vis-a-vis the sale of a personal jewelry. It will not constitute as the in the course or a furtherance of business. Or there are many clarifications issued on the similar line under the service tax regime. Can we take a support? In my view, we can take a support because it is a sale of right in the property and the existing member is not in the business. So anyway, he will not fall under the scope of supply. And since it is not covered as a business under section 217, anyway, GST will not apply. This is my personal view. But here one more thing that comes to my mind. 45 talks about the definite competent authority, specified agreement, blah, blah, blah. Stamp duty value is also referred as per the Stamp Duty Act. But there is something called 50C2, which says that if the value adopted for the purpose of the transaction is not agreeable to the parties, they can make a reference to the officer and then the matter can be referred to the valuer. And if you valuer finds the value which is for the purpose of stamp duty is revised downward, the process takes time. So will it mean existing member, even though occupation certificate is received, he is offered income to tax, he has filed his return, but if there is a revision in value, will the government do the suo motu revision of ITR filed and process the ITR accordingly? Or the return is required to be revised? And if that time limit of filing the revised return or a belated return is expired, then what to do? That is one food for thought. And one more situation arises. If the value is revised because of the application made by the taxpayer, but the builder has paid the tax based on the valuation provided, you will touch that angle when we come to the valuation slide. Will a builder seek a refund of extra GST paid because of such a valuation difference? We will touch upon that angle little later. But one more scenario. OC is received because of the 100% completion, no issue. But OC is received, say partial OC is received when the 75% completed, or a 50% completed, or a 25% completed. Whether, even if it is a partial OC, whether tax is payable on the 100% capital gain as defined under 45(a), or only proportionate capital gain is taxable. Here, can we apply the provisions of section 80 IBA, which provided for the deduction in respect of the profit and gains of housing projects on a proportionate basis if the conditions are violated as specified under that particular section? In my opinion, capital gain should be taxable in the proportionate manner only, especially considering the principles of equity and the principles of natural justice also, and the principles of literal interpretations applicable to the transactions under consideration. If TDR is allotted to the society due to changes in DCR, it will not amount to supply because I will treat that as a subsidy, which is excluded from the consideration. So no GST implication. But if such TDR is transferred, then it will be subject to capital gains, subject to the taxability as applicable. We'll see. That also I have touched upon. 45(5)(a) is triggered on the receipt of OC or a first occupation. Certificate of completion and occupation certificate is synonymous term, but on account of the first occupation as envisaged under the GST law, 45(5)(a) will not trigger. It will trigger only on the certificate of completion. If a society redevelopment, the new property in the form of a commercial premises is provided by the builder developer to the existing member, then whether the benefit of section 45(5)(a) benefit is still available or not. In my opinion, it is still available because it has talked about the property only. It doesn't talk about a residential or a commercial. So that benefit will be still continue if all other conditions are satisfied, and it is for only individual or a HUF. If it is anybody else, that may not survive. Rates of taxes. We know if it is a long-term capital gain, 20% taxes applicable, subject to indexation benefits. If it is a short-term capital gain, slab-wise, in respect of the property, and based on the income, surcharge and the sales is applicable. That is a very pretty straight formula. There is nothing in that. In GST, affordable housing 1% without ITC, non-affordable 5% without ITC, affordable housing 1.5% without ITC, and non-affordable surplus. Especially if the land is not transferred, then the rate of GST is 1.5% for the affordable housing and 7.5% is for the non-affordable housing. So that fact has to be taken. If you are doing an audit of a society redevelopment, then that fact has to be correlated with the development agreement executed. Commercial property, 12% with ITC, 18% with ITC, 18% is when the land is not transferred. Because typically 1/3 benefit of the land deduction is given if the land is transferred. Commercial, unsold property in real estate project or residential real estate, 5% under RCM in respect of the unsold flats or the unsold office premises. Commercial, 18% under RCM on the date of such acquiring such TDR, and it is can be offsetted against the future GST liability. But here one question comes. If a person is a non-resident, and if that is the case, section 195 compliance has to be done, and correspondingly TDS compliances also have to be done accordingly. Rates of taxes, 1% without ITC, 5%, commercial 5%, other commercial is 12% with ITC. But if the old projects which are ongoing up to 31st March 2019 are still continued, then also 8% and 12% still continues. Probably for continuing in the project, builder must have filed Annexure 4 on or before 20th May 2019 before the superintendent of continuing the old scheme. Still, it's very only, but you have to see the project is started before 31st March 19. And that annexure is filed. That can be the also audit point. Input tax credit reversals. Typically, this is applicable only for projects which are opted out from the old scheme to a new scheme, or any project which is coming from 1st April 19. GST to be paid only in cash, no ITC. They have simplified the life for everybody. ITC availment restricted only to sale of a commercial units with 12% levy. For all other, there is no ITC. Reporting ITC not availed as ineligible ITC in GSTR 3B. reversal and availment of excess ITC as on 31st March 19. RCM on joint development agreements, TDR development agreement FSA by the builder, developer and promoter only. 80% procurement is applicable for inputs, capital goods, input services from a registered taxable person only. And if you have paid RCM, then it is treated as a registered procurement only because you are raising a self invoice as provided under section Rule 31. What is to be excluded? TDR. So if I treat the compensation paid in a different form on account of the society development as a part of my TDR, then I'm out of the 80% stipulation requirements. Long-term lease, which is typically more than 3, any kind of a premium, salami, FSI, electricity, high-speed diesel, motor spirit, natural gas. These are the only exceptions provided for the purpose of the 80%. This is very important from the audit perspective. And if the procurement is less than 80%, then builder has to pay 18% under the reverse charge, and that is to be paid by the June of the subsequent financial year. And it can be done on a project completed basis also. But only one exception, if the cement is procured from the unregistered dealer, then 28% are there. But why 28%? The first is cement is subject to tax at 28%, so government doesn't want to leave. But there are a lot of builders who are procuring the cements for which the actual supply has not happened. And that is what prompted government to keep the exception of 28% essentially. That is what my understanding is. Especially clause 44 reporting also has to be correlated in tax audit in form 3CDB whenever we are looking at the builder's accounts. This is the basic slide. I have taken a permission from my friend who is in Bangalore, Venugopal Gola. I just reproduced because I liked his slide very much. So I have reproduced that slide for the purpose of the discussion. And this is what he has done as per the notification of 3000, how the reversal has to be worked out. Initially, this calculation becomes reversal very complicated if you look at the formula or we read the definitions. But if we start filling up the blanks, it is a most easy calculation. Especially the billing has to be with reference to the percentage of completion method. So that also gives the idea that under GST also percentage of completion method is also preferred even under the Income Tax Act. And if I look at broadly, total ITC availed for should be considered as 100% till 31st March 19. Again, bifurcation between the commercial and residential, 100%. Work done, work pending, again 100%. Sold, unsold apartment, 100%. And billing, also 100%. So it's the formula structure is very nice, very simple. It looks very complicated, but it is very simple if you put figures in the right perspective. This slide is the most important. I want everybody to pay 100% attention. GST on joint redevelopment, TDR, FSI, DA, long-term lease or any other nomenclature. It can be for area sharing or a revenue sharing, property with or without land. It can be old property, new property, freehold, leasehold, SRA, tenanted. Typically, society redevelopment happens if the property is more than 30 years and it requires to be redeveloped. Affordable housing, 45 lakhs is the maximum consideration, but in metro, the limit is 60 square meters and non-metros, 90 square meters. If that is the case, then 1% without ITC, 1.5% without ITC, if the land is not transferred. Notification number of 3 of 2019. But again, that is payable by the promoter developer only. These are the notification numbers. Residential plus commercial, that is RREP, that is project where the commercial area is less than 15% as compared to the total carpet area as defined under the RERA provisions. And if the consideration is less than for even for the commercial apartment that you sell, rate of 1% is applicable. But if it is a non-affordable, that is the consideration more than 45 lakhs, any other area, then 5% without ITC, 7.5% without ITC, in case the land is not transferred. And if the commercial area is also sold for more than 45 lakhs, then 5% or 7.5% as the case may be. Commercial consideration, any value, it can be 1 rupee also. Rate of GST 12% with ITC, 18% with ITC, where the land is not transferred. But on the receipt of occupation certificate or a completion certificate or a first occupation, time of supply is triggered, means the GST is payable only on unsold area, residential or commercial. TDR value, which is determined based on the nearest value of sale of independent buyer. So if we are selling to the related parties, then that related party transaction will be ignored, but independent transaction will be based on that value will be determined. 18% is the rate of GST divided by the total carpet area, or 1% or 5%, or whichever is lower. So maximum RCM to be paid is 1%, 5% of the total project value. For affordable and non-affordable, for commercial it is 12%. And one more thing, if the project is carried on, initially it was an affordable project, contractor would have billed you at 12%, but later on the project is converted into a non-affordable. In that case, builder, developer or promoter developer will pay 6% difference on account of the contractor's bill under RCM in addition to 80%. This is the whole basic structure of the joint redevelopment as applicable from 1st April 2019. Now let's touch upon some angles of right in land or building. 50C, all of us are aware, threshold of 10% is given for the purpose of adopting 50C calculation for the purpose of the capital gains under the Income Tax Act. And if I look at section 194IA, part of building is also defined under 194IA. And Kolkata High Court judgments in ICI has held whole includes part, greater contains less, bigger contains the smaller, omni measures continent C minus. Even a Punjab High Court has heard the same. But here, very important, 50C, we challenge the value of stamp duty valuation for the purpose of 50C. And that value is reduced subsequently. Can it apply to 45(5)(a)? In my opinion, it will apply. And we can take the benefit of the lower valuation for the purpose of 45(5)(a). But here one more question that comes. If builder has paid 5% or 12%, and because of such revision, can he file a refund application? If it is within time limits, yes. If it is beyond time limits, it is lapsed. And other references, if we look at the rights in land, section 27, 32, 50C, 43, 54, 54G, GA, everywhere when a rights in building or land are used. Chapter 20A, 20C, 194 LA, 261 AE, where multiple references of right in land or building of movable properties is considered. So even for the purpose of the 50C, rights in land and building can be considered. There are various judgments which says, means contrary judgments are there. 50C not applicable to rights in land or building. But every judgment has to be studied on its facts. Where land was transferred as a part of the development right, it has been held that 50C is applicable. I have tried to give the Mumbai High Court judgment. And there are some judgment which says where the land was not transferred, so 50C is not applicable. But in my opinion, if the rights in land of building are transferred, 50C is applicable. To a tenancy rights or a leasehold right, 50C is not applicable. Because tenancy is a completely different ballgame altogether. It covers under the rent control regulations. Is there any such provision under the GST? According to me, there is no such provision unless it triggers the valuations as per section 50. In that case, rule 27 to rule 30 would apply. And safe way to look at it, whatever the cost of construction is there, add 10%, pay the GST and the matter is over. If that arises, otherwise no. This I have already answered. If it is transferred before the receipt of occupation certificate or CC or FA, then one out of the 45(5)(a). Other than individual, answer will change because then 45(5)(a) is not applicable to them. Plus that will be covered either as a 45(1). If it is an investment, if it is a stock in trade, then 45(2) will trigger. If non-resident, then all provisions pertaining to the non-residents will apply as applicable. Very important. If it is a residential transfer of building, section 54, and then we have to invest only capital gain. Time limits are provided. And if we are not able to acquire the property, either ready possession or the under construction property, then we need to invest the money under the capital gains unit scheme. Typically, all of us have the view that it has to be invested before 139(1). But if you are acquiring the property before the time expiry of the time limit of 139(4) or 139(5), still the benefit of section 54 is still available, even though that money is not deposited in the capital gains unit scheme. We can take a support of circular number 471, 672, 791 as the case may be to draw the support. Again, if the property is acquired prior to 31st March 2001, then the fair market value we can substitute as on 1st April 2001. It is applicable to both residents and non-residents. Or if the cost of acquisition to the previous owner, if you have received by way of a gift, then it is not a transfer. So cost to the previous owner also can be considered. And if the cost to the previous owner is higher than the fair market value as on 1st April 2000, we can always opt for a higher value. There is no bar. Otherwise, a commercial property which is given only for a rental purpose, it means that the property on which the depreciation is not claimed, it will always go under the section 54, because section 54 is the property used for the residence, whereas any other long-term capital asset will go under 54F. And time limits as applicable for 54, same thing applies to. Only differences in FT 54F, net consideration applies. Is to be invested. So difference is capital gain under section 54 and net consideration under 54F in proportion. And if it is used for the business purpose, then sections 50C will trigger block of assets or a short-term capital gain as the case may be. And for if there are any kind of rights in land, building or any other long-term, then 54F, time limits conditions apply as it is. Let us think, if the land is bought, I have constructed the building, period of holding is more than 2 years for land and building is less than 2 years. Can I say it is a long-term capital gain or a short-term capital gain? Answer is, for a land, it will be a long-term capital gain. For a building, it will be a short-term capital gain. Madras High Court judgment of Ramnath Rao can be used. C. Anand Raman's latest judgment of Seema Shah also can be used for the purpose of that. But here one more thing. Can I, cost of my building construction, can I treat as a cost of improvement as referred in 48.2? And I can treat that as a long term. It's a food for thought. I think one can explore this in an option, if possible. Valuation we have seen under 45.5a, how it is to be done. And this is what typically notification 3 of 2019 and for the unsold flat valuation. Point of taxation in the valuation. Certificate of completion, we have seen it, the other proviso we have seen already. TDR valuation we have seen in the main chart. This is more or less. And after occupation, no GST under any circumstances. But here one more thing. Which says, especially the section 49.7 says, certain modes of acquisition, which defines stamp duty valuation for the purpose of the capital gains deemed as a full consideration. Here, stamp duty value as increased by the cash consideration, which we have seen in the 45.5a. So that is a change which we got to keep for the purpose of the capital gains in case if the such a property is sold post on the receipt of completion certificate, then that value can be adopted for the purpose of the capital gains calculation, and based on the holding, long term and short term will be decided. So here we have touched upon this earlier. So we got to see how things will pan out. There is no clarification, but in my view, builder can apply for a refund if it is within the time limits, or Mafatlal judgment scenario is provided. But one more thing, section 48 explanation provides index cost of improvement can be in proportion to the year in which the transfer has happened. So if I have done the development agreement in 2019, possession is given in 2022. So can I apply the indexation of 2022, or I need to apply of 2019? There is no direct judgment on 45.5a, but there are judgments which are available on 45.2, which are with reference to the same analogy, which provides us the benefit of indexation till the year of taxability of capital gains, even if the capital gain arose in earlier years. It is only a deferred, and circular 791 also can be used as a reference. But let me tell you, waters are yet to be tested vis-a-vis the section 45.5a. Again, what should we report in ITR? Do we report the date of agreement in the ITR, or do we date of receipt of occupation certificate report in ITR? In my humble view, we should go with the date of receipt of occupation certificate for the purpose of the offering the gain to the capital gains and treat the transaction accordingly. Various allowances received. There are three views prevalent. Capital receipt, not taxable. It's a part of capital gains. So 45(1), 45(2), 45(5)(a) as applicable, or income from other sources, and treat it accordingly. And it is subject to tax only if you have not spent that money. Under GST, I will go as per the composite supply and defend my matter case accordingly. And that is the support is also drawn here. I can correlate both and take a benefit. And there are various judgment on the points, capital receipt, tribunal judgments, but there is no High Court judgment on this particular point. Part of capital gains judgments are there, and income from other sources, again a tribunal judgments. But one more thing, if a corpus is registered by the society, can we still apply the provisions of BC Srinivas Setty? In my view, we can, because 55(2) does not include TDR, which arises due to DCR regulations or TDR allotted by the government. So in that case, 55(2), the mechanism of capital gains calculation falls, and because of that, it is not taxable. And this is given in the other judgments of Bombay High Court, which we can use. But one more thing, if society is having an existing FSI and it is, or unutilized FSI, and if that is selling, then probably this will not, it will be subject to tax. Existing area, like it is a normal sold to the builder, all provisions will apply accordingly. Lesser area is given, it will be also applicable accordingly. Method of accounting, it's two method of accountings are typically followed: percentage of completion method or a completed contract method. Income tax, 43CA, 43CB for the construction contract, 50C land building or both, or a rights in land or building. Recommends percentage of completion method, and the same is followed under the GST also, as we have seen. Accounting standards, construction contracts, revenue recognition also says about the percentage of completion method. In AS 15 talked about the completed contract method, but later on it has been clarified by ICI. It is a percentage of completion method. ICDS on construction contracts and revenue recognition also talks about the percentage of completion method, but there is no specific ICDS for the real estate transaction. Guidance note is issued by ICI in 2012 as a real, that also prescribes the percentage of completion method. There is no guidance note for the builders, as I understand. Section 37, especially the explanation 3, if any expenditure is incurred by the assessee, which is an offense or prohibited by law, it shall be fully disallowed. Let us take an example. If the builder is constructing the building without any statutory permissions, will it fall under explanation 3? And if that is the case, will all such expenditure would be disallowed under the section 37? And if expenditure is disallowed under section 37, will ITC benefit in respect of the commercial property CPS claimed against 12%? Will that be also liable to be recovered by the GST department? Food for thought. 1 and 5%, there is no ITC, so there is no issue. 1.5% or 7.5% without ITC, then there is no issue. Only where the ITC is claimed, that issue will arise. TDS under Income Tax Act. If there is a specified agreement, TDS should be deducted under 194 IC at the rate of 10%. But do I deduct 10% for each component? In my view, we should, to be on a safer side, to treat as a part of the TDR cost, we should deduct under 194 IC. 194 IA, especially when the property is transferred by the builder to the member, and valuation as per the stamp duty law is available for the purpose of the valuation read with 49(7), do a member who is acquiring the premises really required to deduct the TDS under 194 IA? Because exception that is provided is only 194 LA, which talks about the TDS on payments of compensation on acquisition of certain immovable property. Whereas transaction of a society redevelopment doesn't fall under the certain immovable properties. It is not a compulsory acquisition. So in my view, TDS will trigger under 194 IA. 194I, rent says any payment by whatever name, any lease, sublease, tenancy, or any other agreement or arrangement for the use of land or building or both. So if I'm paying alternate accommodation cost to the members, do I deduct the TDS under 194I? In my view, if I'm deducting under 194IC, I need not touch 194I at all. Food for thought. 194IA, I have already said because of the reasons. 194I also have touched upon. If the agreement is not registered, then the section 194IC doesn't apply. If the builder has deducted the TDS and you know the specified agreement, we should carry forward and claim in the year in which we offer to tax. If a compensation, my choice is 194IC, or if it is a non-resident, then section 195 will appear. There's a typo error. Some inheritance issues. Existing member has aggregated the redevelopment, but he expires. Then what can happen? Whether he has died with will, without will, and if it is with will, whether the will is genuine or authentic, one has to take a call. And if it is without a will, then Hindu succession law will apply if the person is Hindu, or Indian succession law will apply. Probate is mandatory if there is a will in the state of Maharashtra, Tamil Nadu, and West Bengal. Maharashtra is 75,000 is a cost. Tamil Nadu 25, West Bengal 50,000. Or a letter of administration is also accepted in these several states. Nominee is not the legal owner of the property. He will only act as a facilitator to transfer the property. And builder has to look into all these compliances. If there is a sale of property by the legal heir before the society takes over the compliances, then even a builder has to comply. And if there is an attachment of the property, then one has to examine the notices and the relevant provisions to decide. Sale of under construction property we have already touched. Non-resident, then probably power of attorney, whether it is properly registered in a court, that is to be checked. FEMA provisions will apply. Double taxation avoidance treaty, Article 6 for an immovable property, or a capital gain, Article 13 will apply. And if MLI is applicable, then Article 9 on capital gains will apply, and the provisions has to be complied accordingly. If a builder is declared insolvent or bankrupt, this is the biggest trouble builders are facing, because case can be filed for the corporate insolvency process. If a member is declared insolvent or bankrupt, if the new buyer is declared as insolvent or bankrupt, then what happens? If the society is declared, I don't think society can ever be declared as insolvent. Garnish proceedings are initiated under PMLA or a Benami or a black money. Then what happens? This is the topic by itself, but I said since I'm discussing, I should make a reference and any other implications. Way forward. Is there a requirement to simplify the law? In my opinion, yes. If additional compensation is paid through bitcoins, then all the compliances pertaining to the virtual digital asset has to be complied. But if it is paid through central bank digital currency, we should not face a problem because it is normally treated as a valid legal tender. Can we realistically expect greater clarity on the present vague valuation provisions governing such redevelopment under income tax as well as GST statute? I personally feel simplification is desired of. Is it an area of additional opportunity? In my opinion, yes. We expect more litigation to build up in the redevelopment. Can we really state provisions of income tax and GST law are easily intelligible and applicable? It's very difficult for a common man to understand and a common professional to understand because it is a subject specialization. Can we say that South Pole and North Pole extremes between the statute persist, and how do we bridge the gulf? So again, I come back to South Pole and North Pole to do my own research. Wishing the very best to all the members attending this session if they are considering or carrying out redevelopment, or where their societies are intending or carrying out such redevelopment, or they are discharging their role as advisors or consultants to catalyze the actual realization of the dreams of so many of us brethren who pray and hope that they can soon occupy their new abode. This is the illustrative abode which I have provided. Let me retreat here that I am not here to prove myself today on this intricate topic of redevelopment, but certainly due to discussions, deliberations, and the interactions with all the participants, I have improved myself. These are the various source credits which I can give it for. And I always say, surround yourself with the people who talk about vision and ideas, not people. I appreciate all of you. With this, I hand over the proceedings to the organizers. And if anybody would like me to share any of their comments to improve myself for the future presentations, they are most welcomed with the folded hands. They can put me on my email or they can WhatsApp me, whatever suits to them. Thank you. Their frank opinions will be highly appreciated. Thank you. With this, I conclude my presentation here.
Thank you so much, sir. Now I would like to move towards the Q&A session.
Yeah.
Mr. Shikant Dungre has asked, development agreement executed with consideration of partly area flats and partly money. What is the GST impact on builders in view of RCM?
RCM is 5% is payable. No, you have to determine based on the joint development sheet which I had showed. You have to determine the value of the nearest on the receipt of the occupation. At that particular time, builder will pay 1%, 5%, 12% as applicable.
Sir, Mr. Milind Mutha sir has asked to kindly elaborate on hardship allowance taxability.
3 views: capital receipt, part of the capital gain consideration, or income from other sources.
And sir, Mr. Milind has also asked to provide an example on the taxation and valuation point.
For example, let us take the example ki land valuation is say 30 lakh rupees and cash consideration is 10 lakh rupees. So for the purpose of 45(5)(a), the value to be considered is 40 lakh rupees. I'm giving very simple calculation. I'm not complicating the discussion.
Anyone else want to ask any query? Kindly ask. So I hope there are not any more questions, and if anything is required, you have already provided your contact details, so the participants will happily ask their queries to you.
Okay.
So now I would like to move towards the ending session. Good evening, everyone. I am Siddhant Khandelwal. I'm the Vikasa Co-opted Vice Chairman of Pimpri-Chinchwad branch. I would like to propose a vote of thanks on behalf of Pimpri-Chinchwad branch and Pune City CPE Study Circle of WIRC ICAI. I would like to start off by thanking our esteemed speaker, CA Nitin Bhutta sir, for his insightful talks on society redevelopment's conceptual framework under direct and indirect tax laws. Sir, your valuable knowledge and expertise has been a great addition to our technical session today. And I hope that it will help all our fellow chartered accountants to smoothen the process of society redevelopment. I would also like to thank all the participants who have actively took part in the discussion and shared their valuable insights. Your participation has been very much appreciated. A special thanks to the technical team for their hard work in putting together a successful technical session. We are thankful for their commitment and dedication. Thank you all for your presence and participation. Have a wonderful evening.
Thank you.
Thank you, sir.
Thank you.